Assalamu alaikum friends, welcome to lecture 33 of SBL. After this lecture we have two more lectures to go and then we are over with SBL lecture. So in total there are 35 SBL lecture and today the topic is performance excellence. Here we are going to do all financial, non-financial ratios, critical success factor, the performance excellence. We are going to go through models, that is balance scorecard, the Baldrige performance excellence, benchmarking, the various types of benchmarking, all the types of financial ratios, the formulas are in this lecture. You will get everything in this lecture. So it's very important that you watch this lecture till the end. You cannot skip any part of this lecture. This lecture is your soul. It's the soul of SBL. Okay. Most of the questions you are going to get from this. You can get questions on ratios, right? You have to be prepared for ratios. Okay, we don't know what ratios, but you should always be prepared for the ratios with the formula. You have to know it. You have to know the critical success factor of an organization. You have to know the various ways of benchmarking. You have to know how do you measure the performance of a company using various models like balance scorecard, and Baldrige performance excellence is the most important. Okay, there have been questions on that model, even though it's not every time asked, but you have to be prepared for it. So starting with critical success factor. What is critical success factor? The word critical itself tells you that these are the factors that are very critical, very essential for an organization to have. They should have this factor. In short, they have to perform better than their competitors, not even equal, even better. Okay, these are essential areas that if you neglect, your business is to suffer. See, there are so many things in a business, okay, but not all are critical success factor. Some are desiring factor. If you have it, it's good. If you do not have it, it's not going to have so much of impact. But some, depending on the type of your industry, are very crucial factor. We are going to go through various examples, various industries, and to identify what are the critical success factor in the various industries. Okay, now to identify critical success factor in your SBL exam, make sure which industry is it. Is it an education industry, finance industry, entertainment industry, service industry, non-public service? What type of industry it is, you have to see for it. Okay, next. So these are the performance requirements that are fundamental to an organization's success. This has to be there for your organization to succeed. That means these are those product features. There are so many product features, but not, let's say there are 10 product features, but not all the 10 product features are weighted equally by your customers. Some are weighted very important, they're very critical, very crucial for your customer. They're valued by the customer. This is the area where you have to outperform your competitors. This is that area. Okay, now let us go through 4 industries where what are the critical success factor of it, starting with automobile industry. For automobile industry, what do you think? Styling. How do you style your car? You have to have a very efficient dealer network. Remember, it's like a network. You have to have a dealer. Organization performance. So these are the critical success factor for any automobile industry. Going to food industry. For food, we all know you have to have a new product development. Always you have to come up with new things. You have to take care of health so that you make certain goods in low fat. You have to have a good distribution channel also. You have to distribute this. Okay. Life insurance industry, for them, reputation, and they should always have this innovative new policies. For them, that is their critical success factor. Then we have supermarket industry. What do you think? This is easier. Supermarket industry is something which anyone can do. Having the right product, okay, in the shelf with the right price, right? That's what supermarket is, right? When you go to supermarket, what do you do? When you don't see a product that you want in your shelf, what do? You become dissatisfied, right? It has to be there in that shelf. So right product with the right price has to be there at the right place. That is the critical success factor for supermarket industry. Now we are moving on to the financial ratio. That's it for critical success factor. We don't have a question in this lecture, okay? But it is your responsibility that you have to pick this question from past paper and do it. Okay, I will be doing one past paper before your exam, SBL exam for sure, but that does not mean you have to wait for me to finish it. You have to do your own work. There are so many past papers, okay, which have critical success factor to talk about. Search for it. It's your job. Now we are moving on to financial ratio. This is easiest because you have studied all this in your previous paper. Management accounting, financial accounting, whatever the paper, you name it and you have studied this. So in SBL, do not come unprepared. Don't think because in SBL textbook ratios are not there or because so much detail has not been explained, you don't know. No. Maybe the calculations are not given so much in the textbook, but you have to know the ratios. Why? Because in your exam, one exhibit they will give on finance only. 100% there is no doubt. You have to have some numbers. Balance sheet will be given, or cash flow statement will be given, or it will be given in a form of Excel or anything. So you should be able to do calculations. So don't expect in SBL you don't have to do calculations. Be ready with your Excel. You have to do. Even not in a majority proportion, but you have to do it. Sometimes your answer relies on that calculation, what you have to do, ratios that you have to do. If you have to interpret a performance of the company, you have to do financial ratios, right? Even though the question specifically requirement will not ask you to calculate performance financial ratios, but you have to do it. That's how you're going to analyze the performance of the company. So starting with financial statement, what do they examiner can give you financial statements also or some extracts which students have to use. They have to pull information from there. Remember that financial statement is given there for a reason. Don't ignore it and keep it aside. Okay, so these are some important technique points. Okay, there'll be some important technique points to this. For example, this is the way you have to do a question on ratios. Okay, you have to choose 3 to 4 key ratios. Key ratios, you have to decide which ratio for which industry is most suitable. Depending on the information that is given to you, you have to see whether it is gross profit margin will be more suitable, or whether it is liquidity more suitable, whether it is investor ratio. You have to decide. You have to use a judgment there. Depending on the information that is given, we'll do questions on this. Don't worry. Why 3 to 4? See, the ratios that you have learned. How many ratios you have learned? Tell me. Under profitability 3 4. Under liquidity I think 2 ratios. Efficiency ratios are there 5. I think around 20 ratios are there. If you have to count it. Not exactly 20, but somewhere it will be in that range, 15 to 20 ratios. Is it possible in SBL exam you give all the whatever you have learned, all the ratios you can give? It is not possible. It is not possible. You are going to waste time. Only 3 to 4, not even 1. 1 is too less, 2 is too less, 3 to 4. Key ratios. You have to calculate and discuss. Keep it 3 to 4 only in any SBL exam, because more than 4 ratio you are not required to give. Okay. Next, there is no need to illustrate the formula or calculation. Please do not emphasize so much on giving formulas. The moment you calculate it in Excel, it is shown that you are using the formula. For example, you have to calculate net profit margin. What do you do in the cell? In Excel, what do you do? You will write equal to, click some cell where net profit is there, or you type the number, divide by sale. So automatically when the examiner clicks the cell, they know that you have done the formula. So you don't have to write it. Sorry, net profit divided by sales into 100 is equals to gross profit margin. Then again you will start doing calculation. Do not waste time doing all this. It's not necessary. It's not needed. Thank God now it is on Excel. It is not no longer paper based, so you don't have to. Third, only one comparator should be needed. When you using ratio, remember you need to compare. How can you say whether your ratio is good or bad? You have to compare it against your competitor, against the time period, or against the industry ratio averages that is given to you. You have to compare it. So when you're comparing, don't use 2 3 things to compare, only one. For example, you're using gross profit margin. You can compare it with the previous year. You can compare it with the competitors' gross profit. You can compare it with the industry averages. But use one. Okay. Then, very important is the last point, which many of you do not pay attention to and hence lose a lot of marks, because lots of your marks is in the last stage. That is explain the cause why a change has happened in the ratio. For example, you can see 2 years ratios has been given. Gross profit margin you calculated. This year is 30%, next year it is 40%. So automatically you will say gross profit margin has increased, which is good. No, this is not what you have to write in SBL. You don't have to write average. I mean, it is already, it can be seen. You are not adding any value by saying it increased. So what gross profit margin increased or decreased? What is the impact on the company? Why it changed? What caused this change? These are the things you need to answer. The causes why gross profit margin increased. Find the reason behind it. Is it because the sales volume increased? Is it because the sales price went? Why? How? You have to investigate. When you investigate, remember there are so many pieces of information not even in the same exhibit, but it might be given in other exhibits you have to look for. Some non-financial, sometimes you have to read. Sometimes through numbers you will get it. Okay, so that you have to explain. There, focus more on explanation part. There is that area where you can score maximum marks, not just by calculating ratios, not just by, you know, comparing against each other, saying this increase, that decrease will not help you. Now, starting with choose to 3 to 4 key ratios. Okay, for example, if you have been given pestle, okay, you can use sales growth ratio. This can be linked to pestle, sales growth. Sales growth is one of the key ratios. Most of the time you can use this sales growth. How? Because we are always concerned about how much our sales have increased, right? Or you can say margin, how much your margin has improved or declined. This you can relate to the five forces model. Whenever you are given a five forces model, through that you will be able to calculate margin. If they are not giving numbers also, at least you can write margin is going to be strong or weak. Why? Because five forces means the competitive position. How competitive your market is. Higher the competitive, lower the margin. Less the competitive, higher the margin. That's how it is, right? For sales growth, why pestle? Because demand, whether you have demand, your economic factor, you can see your political factor, you can see your social factor, whether customer has improved or not, demographic as how it changed. Through all this you can understand, you can find out sales growth. Then gearing ratio is also a very key ratio. This gives you about the risk profile, how risky your company is. If it's highly geared, you cannot add keep on adding debt. That's what it implies. Next, remember this, in SBL ratio analysis will, you don't have to do all those calculations like 10 12 different ratios you have to calculate. It is not going to be asked in SBL, don't worry, because it has already been done in your level. Okay, so what are we going to do here? In fact, you should not even add a ratio if it does not add any meaning to the story, to the whole picture. One example is, for example, let's say you are calculating receivable days, okay, but in both the years receivable days has not changed. Then what's the use? Neither it increased nor the decrease, it remained the same. There's no point in calculating the receivable day. You are wasting time, in fact. And also you can see business does not even have a problem with debt collection. Then why to calculate receivable day? Receivable day we calculate in order to find out how late our customers are paying us. But if there is no problem with debt collection, why do you have to find receivable day? It's not worth it, right? I mean, it's waste of time. So you have to be very judgmental. You have to use your own judgment there. What ratios I should take, what ratios I should not take. That is totally up to you. Okay. Now, no need to illustrate the formula or the calculation. That means you don't have to tell, okay, gross profit margin shows how much profit the business is making per dollar of turnover. You are not going to get any marks. So don't explain that ratio. Sales profit margin is going to measure how much sale has been done. No, avoid. Only one comparator should be needed. Yes. Sometimes what happens, you will see, you will be given 4 to 5 years worth of financial statements. 4 to 5 years of sales, 4 5 years of sales or cost or anything, right? Is it worth that every year you keep calculating and then say this year it increased, that year decrease, again it increase? Does it give you any good picture? No. Then how do you do that if you're given for 4 to 5 years? Every year you don't have to calculate ratios. We normally, what do? We calculate the first set of financial statements ratio with the last, the recent. In between ones we don't calculate. Or you can do the other way. You can compare this year with just the previous year. That's it. Last year. So either of these two you can do. Either first set of financial statement with the last, that is the first and the fifth year, or the fourth and the fifth year. Anyway. Then you have to focus on the causes of the change. Why it changed? What could be the reason? Now we are moving on to the types of ratios. Okay, I will quickly move on through this because this is something which you have done it in your F level and you must be knowing it. So under profitability, ratios are divided into 4 categories. Starting with profitability, it measures your profit. So profitability ratios, number one, we have ROCE, that is return on capital employed. This is how you calculate operating profit. Operating profit means profit before interest and tax, PBIT, before interest and tax, divided by capital employed. See, you have to know the places also where you are going to get it. Operating profit you will get from your statement of profit and loss. Capital employed you are going to get from your statement of financial position. Okay, into 100. Next, gross profit margin. Gross profit margin is simply your gross profit divided by sales. Both of them you will get it in your statement of profit and loss. Net margin is just the net margin into sales. ROE, this is return on equity. Okay, so equity means what? That means what are the equity shareholders going to get? So they are only going to get after deducting tax and your preference dividend, remember. So that's why we are taking profit after tax and preference dividend divided by shareholders fund. Okay, into 100. Next set of ratio is liquidity ratio. Under that we have two. One is current ratio, the other one is asset test ratio. Current ratio means current assets divided by current liabilities. Asset is you deduct the stock from current assets and divide by current liabilities. This you will get from a statement of financial position. Okay. Ideal is 2:1. That means 2 asset for 1 liability, or 1:1. But if it's the other way around where your asset is less than your liability, then it's not so good for the company. Okay. Having too high a ratio is also not good. Remember, if it's 5:1 is also not good. Why? That means so much of your current asset is lying idle as stock. Right? That's what it means. Whereas having too less of current asset, that means you will not be able to pay your interest of the loan or all those, your current liabilities you will not be able to pay. So in both, you should not be there. Okay. Next. Third set of ratios are known as efficiency ratio. Under that we have asset turnover. That is sales divided by capital employed. Okay. Return on capital employed. You can find it out in another way also. Earlier we have told you, right? Profit before interest and tax divided by capital employed. There is another way of finding out. In case that is not applicable, that is this one. Know both the formulas, but that is net margin. That means net profit margin into asset turnover. Okay. Then we have receivable day, payable day, inventory days, which measures your working capital basically. So receivable day means receivable balance divided by credit sales. Credit sales, not cash sales, into 365, because there are 365 days. Out of 365, how much you are calculating the receivable days. So when you're calculating days, don't forget to multiply by 365. Payable also same. It is just the payable instead of receivable. And instead of credit sales, it is credit purchases. And if for inventory, it is inventory divided by cost of sales into 365. Okay. Then we have revenue per employee. That means sales divided by number of employees. Fourth is gearing ratio, which is very important. For gearing ratio, first is known as financial gearing. It could be debt over equity or debt divided by debt plus equity. It could be in any of these two ways. Then investor ratio. Under investor ratio, we have dividend cover. That is PAT, that means profit after tax, because see, dividend will be paid after tax. So profit after tax divided by total dividend. How much are you able to pay a dividend? Okay. Interest cover, how much with your profit are you able to pay the interest? That's why we are taking interest, we are paying before tax and before interest obviously. So profit before interest and tax divided by interest. Okay. EPS, earnings per share. When you're calculating earnings per share, for whom are you taking it? For equity holders. That means after taking out tax and preference dividend. So profit after tax and preference dividend. That is your earning. Divide by number of shares because price per share into 100. Remember, higher the EPS, better it is. In fact, all of this, higher it is, better it is, except financial gearing. Gearing should be high, but not too high also, where where the risk is more than the benefit. Then we have PE ratio. See, PE ratio and EPS are linked. How? Look at the formula of PE ratio. It is share price divided by EPS. That means you must have already calculated EPS before getting PE ratio. Got it? Now, we are moving on to non-financial critical success factor and KPI, that is key performance indicator. On the left hand side, we have critical success factor. On the right hand side, we have the key performance indicator. They are not the same thing. So do not get confused. Okay. Critical success factor could be competitiveness. Maybe your critical success factor is to stay competitive. Now, how do you measure this competitive? That is what key performance indicator do. You can see the sales growth by product or by service. This will tell you how competitive you are. Higher the sales growth, more competitive. Or you can see the measure of your customer base. To know whether you're competitive enough or not, look at your customer base. If customer base is strong, means you're very competitive. Relative market share and position. If you're having a small percentage of that share, market is highly competitive. That's why you're not able to take a big proportion from your competitor. If competitors are very less, you will have a huge market share, right? Then resource utilization could be a critical success factor for an entity. How do you measure it? You check the measurement of resources that are planned against consumed. Are you using more than the plan or less than the plan? Second, measurement of resources available against those used. Third, productivity measurements. Quality of service. Okay, for how do you measure it? Quality measures in every unit. Evaluate the supply on the basis of quality, not the price. Because if you're choosing a supplier with a good quality, definitely your service will be of good quality. You see? In short, all these key performance indicators are measuring how much are you able to achieve your critical success factor. That's what they are doing. That's the link between these two. Number of customer complaints received. Higher this one. Complaint received, that means your quality of service is bad. It's poor. You need to work on it. Number of new accounts lost or gained. If you are losing accounts, quality of service is deteriorating. Then we have customer satisfaction. How do you measure this? Speed of response to customer needs. If the speed is high, customer automatically will be satisfied. Second, are you doing any calling to your customer each week? Maybe you are doing some informal calling, right? Number of customer visits to the factory or workplace. Through that also you can measure customer satisfaction, or number of factory and non-factory manager visits to the customer. They go and see the customer. Quality of working life. How do you measure this? You measure the job satisfaction. Are the employees happy with their job? Or are they just doing it to survival and just to pay the rent and all those things? Second, days absent. Higher the days they are absent, that means they are suffering. Quality of working life is suffering. They're not happy. Labor turnover. If this is high, means it's not good. That means more of your labors are moving away from your business. Overtime. Should they work overtime, or are they able to get or afford with the amount of work that they are putting? If they have to work all the time overtime, it's not good. It's not a good sign. Then we have innovation. This, you see the proportion of new product with your old. If it's high, that means it has been innovated. Then you see the new product or the service sales level, because everything ultimately needs to be sold. If you have an excellent idea with excellent product, with the right marketing mix at the right, everything is perfect, but the sales are not increasing. Do you think it is of any use? No. At the end, always tell that whatever it is, the idea is good, bad, whatever it needs to be sold, because only your sales figure will tell you how successful you are in your innovation. Then responsive lead time, maybe you want to reduce this. So order entry delays and error. When you're ordering, the entry. You see, are there any delays or error? If this is high, that means it is taking a longer time to respond, which is not good. Wrong blueprints or specifications might make you take longer time. Long setup times and large load, again not good. High defect count, not good. Machines that break down, because if machine break down, you need a longer time to respond. It will increase your lead time. Now, quality of output. This you will get the return from your customer. Remember, if you are getting a higher return, that means sales return from your customer, it's not good. That means the quality of your output was not good. Reject rate, if this is high, quality is not good. Reworking cost, this is high, quality is not good. Warranty cost, if this is high, quality is not good. Then we have flexibility. For flexibility, we see the production and the service introduction flexibility. Then we see the mix flexibility. Then we see the volume flexibility. Then we see the delivery flexibility. Then we see the time to respond to customer demands. All these things will decide how flexible you are. Now we are moving on to the KPIs. Okay, see in your exam, okay, how do you use it? In your exam, you might be given some of the KPI. Maybe you don't have to calculate, but you're given some of the KPIs, such as customer return or percentage of repeat business, market share, age of product, anything, alongside the financial information. Remember, when you are given this type, you have to use it along with your financial ratio. This also has to be used. Okay, now we are moving on to the types of benchmarking. So we are done with all the ratios, KPIs, CSF. Now we are moving on to benchmark. The types of benchmarking. We all know what is benchmark. I don't think I have to include the definition because it's not worth it. I mean, you don't have to explain all this definition in your exam. This is not a knowledge-based paper. That's why I didn't waste so much of time writing, what benchmarking is all about. If you want to know the detail, you can go back to your textbook and read, but it's not required from the exam's point of view. So I jumped to the types of benchmarking. But let me tell you what benchmarking is. Benchmarking means you are keeping someone against whom you have to, it's like you are keeping them as your idol. Okay, maybe they are the best in your field. You want to behave, you want to perform like them, or even surpass them at some point. But you have to keep someone as your idol, as your role model, by which you can compare yourself, how bad or how good you are doing. Understanding? That is benchmarking. You're marking yourself by using someone else, by keeping someone as a reference point. That is the meaning of benchmarking. So there are three types of benchmarking: internal benchmarking, competitive benchmarking, you see the industry, and activity benchmarking. And the fourth one is generic benchmarking. Sorry, four types. Generic. We'll go in detail to each of these four. Starting with internal. Okay. Internal benchmarking, let me tell you. You do it inside your organization. This is often year to year. You keep a benchmark that this year you have to produce this much. It is internal. Competitive is also easy. You check your competitors out, rivals, and you benchmark. Activity is also based on the activity you benchmark. Okay. Generic, I have to explain you what generic benchmarking is. Okay. See, for some activities, the process might be so unique that they may not be competitive or activity benchmark available. Some products are so unique, some activities itself is so unique, you will not even get a benchmark also. Because to get a benchmark, a lot of people have to do the same thing that you are already doing. Then only you can have a benchmark. So in this case, you use a similar process. Maybe what are the similar process someone will do in my condition that you can use as a benchmark. For example, okay, let me give you an example. When building a rail tunnel, okay, in Japan, what happened? They wanted to make a rail tunnel connecting two places in Japan, and this was under the sea. So the construction company that time, they had no similar activities again which to benchmark themselves, because no one that time had this under the sea tunnel. Now what to do? Because under the sea tunnel between England and France was yet to be built. They have not been built yet. So how do you compare yourself? But however, This tunneling was conceptually similar to the explorations into volcanic crust. And this process was used as a benchmark instead. What is it? Exploration into volcanic crust. This was taken as what? Similar to tunneling. Now don't ask me what is the logic behind this, why they have used it as similar. You don't have to know it. Just use that you can use it as a similar, and that's how they have used it as a benchmark. That is known as a generic benchmarking because they are not specific. Now, what are the benefits of benchmarking? Everything has a benefit and drawback, okay? The benefit is it can improve your performance and add value. Second, you can understand environmental pressure even better now because you know how the actual world looks like, where they are performing, why they are in such level where they are at. Third, it will improve your competitive position. Why? Benchmarking will reveal a competitor's relative cost position, and also it identifies an opportunity for you to improve. Maybe you will improve and reach a point where you will even perform better than your competitor. Even beyond your benchmark, you will cross and go. Okay, takes time, but it happens. Creative process of change. Yes, benchmarking will lead you to creative process of you will change. You will not keep on performing the same way that you were doing before. Once you know the benchmark, you know how you have to perform. A target. This is like a target that gives you the motivation to improve. Then you can learn a lot. Okay, it brings new ideas into company and facilitates sharing experience from the other companies. Next, the dangers of benchmarking. Number one, you get what you measure. Sometimes what you measure only take it as a benchmark. It might not be strategically important, but because it could be measured, you are taking it as a benchmark. You have to take a careful decision there. Then benchmarking will not reveal the reason why your performance is good or poor. It will just give you an comparison thing. You can compare yourself against it, but why your performance is bad or good, it will not tell. Third, managers has to be aware of this benchmarking exercises. Why? It can threaten the staff. Because benchmarking is designed to identify weaknesses in the individual performance. So it can threaten, right? No one wants their weaknesses to come out or to be revealed through benchmarking. So what do? They feel threatened. Rather than thinking that this process can be improved. Through benchmarking, process can be improved, no one thinks. Then fourth, in today's environment, remember, innovative companies, they are not so much of concern about benchmarking because they are focusing on the process, how to reduce the cost and improve their productivity. Okay, which is good. Now we are moving on to the balanced scorecard, a model that measures your performance, whether you are an excellent company or not. How? It measures your performance against four perspectives. It has four perspectives. Balanced scorecard. Why? It gives a score to all these four elements, but it's balanced in a way. It is not towards one side, financial side or just non-financial side. It takes both into the picture. That's why it is known as balanced scorecard. You don't have to know the details or how it was built. All those things is not needed. Stories and stories are there. Okay, what you have to know is what are the four things. Okay, and have you achieved them or not? Are you performing better or worse in these four areas? And in all four areas you have to exit. You have to perform good, not just one area and other three areas are not performing good. But what are these four areas? First, financial perspective. In terms of your finance, you need to perform good. So this balanced scorecard, you will know, are you weak? You will know your weaknesses and strength. Are you performing good in your financial perspective or not, or you need to improve? Are you meeting your financial targets or not? Second is customer perspective. Are your customers satisfied? Are you meeting their point? Third, innovation. Are you being innovative? Because innovation is a must for the success of any company. For the success of any company, customer is a must. For the success of any company, you need finance coming in, going out. You need sales to take place, right? And the last but not the least is internal business process. Nothing happens without internal business process. Whether you are a bank, whether you are giving service, whether you are in the manufacturing sector, whatever you are, there is a process. And that process Okay, needs to be taken care of. So you have to see whether this process is efficient. Are the employees satisfied and motivated or not? Because employees are the one who are in this internal process. You understanding? So they need to be satisfied and motivated. So in all these four areas, you have to perform well. Not just, let's say you are performing in your financial perspective, but your customers are not happy currently. Okay, they are dissatisfied. You're not being innovating. But in terms of finance, in terms of number, you are doing good. So that will not give you a sustainable return in the long term. You will suffer at the end because they go hand in hand. All the four needs to be, you need to be top in all these four areas. Okay. Now, last model, the most important model that is the main focus of this lecture also, performance excellence. That is the Baldrige performance excellence, because Baldrige is the one who have brought up this model, performance excellence. So to assess that your performance is excellent or not, Baldrige model, what do? They assess your performance against 7 categories. You have to know the 7 categories from the point of your exam also, SBL. Because if this model you have to use it, you have to talk about all those 7 categories. Yes. First category, leadership. How the organization leadership guides, how they govern, how they sustain the organization performance. Everything starts with leadership. That was our first lecture also, remember? I told you. For the success of any business, you need a good leader. Second, strategy. Strategy. Your ability to successfully plan, develop, and then implement those strategies. For example, are you going to be a cost leadership or differentiation? What road are you taking? Third, your customer. Are you having a success in building long-term customer, repeat customer? Are you having a long-term relationship with them? Then workforce. Are they happy? Are they satisfied? Are they able to meet their goals? We have more operation. Are the design and the organizational process effective? Result. Finally, the result. You check your performance against the competitor. Okay, then you will know whether your result is good or bad. And measurement, analysis, and knowledge management. How data is stored, managed, analyzed, and used within the organization, because now everything is about data only. So this needs to be managed very well. So let us go in detail in all of the 7 categories, starting with leadership. Leadership, I would not have given you all these details, but the reason I've given you this detail is because I know you need some points to write in your exam. So that's why I've included this thing. Okay, leadership will consider an organization in areas such as whether they have done. So this is the question that you need to answer basically. Whether the leaders have clear, well communicated goals or not. Whether there's a corporate governance, strong corporate governance practiced or not. For example, taking all the stakeholders' view, right? Third, whether wider social responsibilities are considered or not. Strategy. For strategy, whether there is a clear objective or not. The ability to create plans, whether the strategic plan fits with the strategic objective, how strategies are developed and implemented, whether suitable and sufficient resources are given for the strategic implementation. All these things question needs to be answered. Okay, whether it measures success or failure of strategic objective, you have to measure it. You have to know whether your strategic objective is a failure or not. That you have to measure. Remember, if the answer to this is yes in all of this, that means in terms of strategy, you're performing excellent. Hence, performance excellence. That means you're performing well. Customer. For customer, what is the level of customer support you are giving? Customer complaint management. Are they managed? The level of customer interaction and engagement. Whether customers are segmented and product and services personalized to those segment. Workforce. So organization have to consider all these things. How they recruit and retain, how they have a career progression for workforce, how they are trained and developed, how they are given the rewards and schemes, how they appraise the workforce, how the workforce engagement, how engaged the workforce is with the organization. If they are positively engaged, means is good. You're performing good. Operation. whether processes are reviewed and assessed, whether processes are improved, how effective the processes are in delivering customer value, results. Okay, will consider organizational improvement in all key areas like product and process result. You have to do well in product in terms of process, also process, customer result, workforce result, leadership governance result, financial and market result. If you see, result will bring all your other 6 elements there, starting with finance, workforce, leadership, customer, product, everything, all the result you need here. Overall result you have to give after taking all the individual results together, add up and see what is the overall result. We have management, knowledge management, measurement and analysis. Here, how the organizational knowledge is maintained, how it is and shared, whether benchmarking is used here or not, which performance measures are used and how data is collected, whether action is taken as a result of performance measurement. Okay, now, so from this, what can you see? Something can be seen, right? From this, it can be seen that the Baldrige values include all those things. What is it? These are the values. Visionary leadership. Leader has to be a visionary. They should have a vision. That means performance will be good. Second, they should be customer driven excellence, taking care of customer. Organizational personal learning, they have to be learning. They have to value their customers, employees. They have to be agile. They have to focus on the future, not backward looking. They have to manage for innovation. They have to, the management by fact, who looks for evidences and all, not just by their own opinion. So all these things are the values, you see. If this is present in an organization, that organization you can say is performing in an excellent manner. If any of this is lacking, that is an area where organization has to improve. So this will give you an idea, right? Social responsibility, exactly. Even this is very important value. So it includes also this focus on result and creating value, system perspective. An organization that scores well in the areas of model should be better at. Remember, if organization is scoring well in this area of the model, okay, what does it mean? It means it is better at achieving its strategic goal. They can meet their strategic goal easily. They are competing, better at competing compared to their rivals. They are improving their result. They are improving and learning, and they are meeting customer needs also. Now, let us summarize all that we have included in this lecture, which all the 4 areas can be termed under one umbrella or one heading, that is known as performance analysis. What are we doing? We are just simply analyzing the performance of a company by using various models. That's what we have done. So we started with quantitative analysis. What is it? What does it do? It incorporates into strategic analysis. How you put this analysis into your strategic analysis. In short, whatever you do, your quantitative analysis, that means you have to be able to achieve your strategic goals. It should help you to achieve your strategic goals, otherwise there's no meaning. Then ensure to consider critical success factor and key performance indicator. It's a must. Then we went through financial analysis, all the type of ratios you have to know: profitability, liquidity, efficiency, investor, gearing. 5 types. Okay, in your exam, choose 3 to 4 key ratios, suggest why each one has changed. Each one has changed, you have to suggest, and you have to discuss the impact on the business. Okay, then go through benchmarking. We went through 4 types of benchmarking, if you can recall: generic, internal, competitive, and one more is there, I think. I kind of forgot, but anyway, you can go back and see. So this helps you to evaluate your position in terms with compared to your rival or anything, or against the time. Can set strategic targets, right? Because you're having a benchmark, now you can set a proper strategic target. Earlier you were not setting it because you don't have any benchmark, you don't have any motivation. Now you know when someone else is performing better than you, your thing will be how to achieve that or go beyond that also. So you will have some target for yourself, right? Benchmarking does that. Baldrige model, the 7 elements: leadership, strategy, customer, workforce, process, results, and measurement. That is your knowledge management and all. We also went through the balance scorecard. Don't forget that, which I didn't include here, but anyway, that is, I will tell you, the four element, that is customer, financial, innovation, and the process. So that's it for this lecture. Thank you for watching and see you in the next two lectures we have. One is for process improvement and the last lecture will be your project management. Both are equally important. So if you have not subscribed to my channel, don't, what are you waiting for? Please go and subscribe to my channel. You know exams are coming near, right? My SBL playlist almost have all the lectures. If you have not watched my previous lecture from 1 to 31, please, or 1 to 32, please go back and watch all those lectures today and take the maximum benefit, as you know exams are coming, and best of luck for your exam and see you in the next lecture.